We're going to talk about the difference between insolvency and bankruptcy using Spongebob memes. Now, insolvency just means that you have more liabilities than you have assets. And if you're an insurance company, your liabilities are your claims. The challenge is that you don't know how much your claims are going to cost. You have an estimate that is based on an actuarial study that says how much they think your claims are going to cost. And that estimate is based on another estimate made by the adjusters, reserving that money for the claims based on how much they think it's going to cost. But ultimately, you don't know how much those claims are going to cost. So if you are insolvent as an insurer, that is a very risky place to be, because that already means that your liabilities exceed your assets and you still don't know the full amount of what those liabilities will be. So think of insolvency as you're sick and you need to go to the hospital. You're sick. It's a condition. You can get out of it. It's possible, not easy, but possible, through a cash infusion or other methods. But think of insolvency as being sick. Now, bankruptcy is a process. Bankruptcy is a legal process. That is essentially you going to the hospital to get help. That's what bankruptcy is. So the bankruptcy itself is just the legal process. The insolvency is the financial state. And this is why reserving is so important. It is so important that adjusters are reserving accurately, because that estimate is the estimate that the actuaries are going to use to model for the future, to figure out what those liabilities are. So reserves are incredibly important, not just because they affect your premiums, and they do, but also because for an insurer, that's how they model into the future to make sure that they have enough assets to cover the cost of the claims. So to recap, insolvency, Spongebob is sick. Bankruptcy, Spongebob goes to the hospital to get help.